Here in India, the central bank has dropped a surprise. That's the RBI, the Reserve Bank of India. Today, its monetary policy was announced. Most of it was along expected lines. There was no change in the interest rates. The interest rates will stay at 6.5%. So your loans and your EMIs will cost the same. Does this mean inflation has largely been controlled? Well, not really. It means the RBI is changing its strategy. Instead of interest rates, they're using something else. Bonds. Listen to Governor Shaktikanta Das.
Declining core inflation is a silver line, but headline CPI inflation remains vulnerable to recurring and overlapping food price shocks. It's emphatically reiterated that the inflation target is 4% and not 2 to 6%. OMO sales will be undertaken as necessary.
OMO sales will be done when necessary. That's the statement that has captured everyone's interest. So what exactly is OMO? It stands for Open Market Operations, OMO. Say the RBI sells government bonds in the open market. That's OMO. If they buy government bonds, it's the same. So what's the RBI doing now? They're planning to sell government bonds when necessary. The idea is to soak up liquidity. Let me explain how this works. Suppose the RBI thinks there is too much liquidity in the economy. Maybe the banks have too much money lying around. As a result, inflation is creeping up. Then the RBI will sell government bonds. And who will buy them? Banks or corporations or mutual funds. They buy bonds. And these purchases will take money out of the economy. So liquidity down, inflation down. That's the RBI's game plan here. And just to be clear, the central bank has already been doing this. They've been selling bonds in the open market to drain liquidity. In September, they sold bonds worth $853 million. That's around 7,100 crore rupees. So how is this announcement different? Because these bond sales will be done via an auction process. I know it sounds complicated, but the RBI basically is giving us a message. The message is this: the threat of inflation has not disappeared. A couple of reasons for that. Number one, the poor rains. India has recorded its weakest monsoon in 5 years. Consider the June to September period. Rainfall was 6% less than average. And when the monsoon fails, India's crops fail, which means food inflation, food prices go up. In August this year, overall inflation was 6.8%, but food prices were up close to 10%. Do you know what that means? Food prices could drag inflation up, and that's a worry. Reason number two is fuel. Saudi Arabia and Russia are cutting oil output. They want to keep oil prices up. The government too is aware of this problem. Recently, India's petroleum minister issued an appeal. He asked oil-producing nations to show sensitivity. In other words, to cut prices. And these two factors, food inflation and high oil prices, could worsen India's inflation. The RBI is aware of that, hence the bond sales. And how is the market responding? Sharply. Not many people saw this decision coming, plus the RBI did not give any details about the process, like how much will they sell or when will they do it. And this lack of clarity has caught the market by surprise. The government's 10-year bond registered a sharp increase. In fact, its biggest single-day jump in 14 months. The yield was 7.2% in the previous session. It closed at more than 7.3% after the announcement. What does all of this mean for the Indian economy? It means that a tricky period is coming up. The growth is still expected to be robust. The World Bank projection is a GDP growth of 6.3%. So India will be among the fastest growing major economies in the world. The RBI's projection is also thereabouts, 6.5% for this financial year, 2023-24, 6.5%. But all these reports and agencies warn of one risk, and that is inflation. You just heard the RBI governor. He said inflation target is 4%, not 2 to 6%, 4%. So don't expect the RBI to ease off the pedal. Not even if inflation falls below 6%. Their policy is still hawkish, much like every country in the world right now. Take the United States, for instance. Their central bank has been increasing interest rates since March 2022. Last month, they paused. They held the interest rate steady, But that does not mean that the pain is over. America's central bank says one more rate hike is expected this year. And if that happens, it would be the 12th hike. A dozen interest hikes since 2022. So the economy is not out of the woods yet. Inflation remains a major problem. If prices rise out of control, there will be further tightening. And if that happens, you can forget all the rosy GDP estimates.